Welcome back, everybody. Earnings season has started, and that means we may see some big swings both up and down for stocks that we own. But the fun part is that we also get to see how the businesses behind the stocks are performing and hopefully catch some irrational market reactions to add to great companies at good prices. Now, a lot of the biggest companies in the market have yet to release earnings, but two stocks near and dear to my portfolio have, and we're going to talk about them, namely Taiwan Semiconductor and UnitedHealthcare. So let's go ahead and get started. Now, we'll start with Taiwan Semi, and what I'd like to do is go back to the previous quarter and the guidance that the company gave just to see how they actually performed against their own guidance. Now, what they planned for Q4 of 2024 was revenue being between 26.1 billion and 26.9 billion, gross profit margin between 57 and 59%, and then operating profit margin between 46.5 and 48.5%. So then if we take a look at what they actually reported, we see in US dollars, fourth quarter revenue was 26.88 billion, which was right at the top end of their guidance range. And gross margin for the quarter was 59%, again at the top of their range, with operating margin at 49%, which was slightly above what they gave as guidance. So overall, TSMC basically met or exceeded their guidance, or even when they met their guidance, it was at the top of the range. So all those numbers are pretty strong. And if we take a look at the market's reaction, TSMC was up about 5% the day after their earnings were released, and it's come down a bit since then. But this is a stock that year to date is already up over 7%, and over the past year has doubled, while in terms of ratings, just about everyone has it as a strong buy or buy. So why is that? Well, I've actually been adding to my TSM position over the past few months, mainly because I view it as a critical company in a strong secular trend that, in my opinion, is trading at an attractive multiple. And obviously, I've gone deeper into the whys than just that, but I feel like understanding the big picture for our stocks really helps us from overanalyzing or just overthinking these things sometimes. But part of the reason I think the market continues to push TSMC higher, their market advantage is getting bigger. Because when it comes to AI or technology, I think everyone is always looking for that next thing, but sometimes the next thing is really the current winners that are getting stronger and getting better. And this is where understanding the revenue breakdown of the companies you invest in can really help. Like, let's take a look at TSM's most recent earnings presentation. So what you see is that high-performance computing, where AI-related chips live, as well as smartphone, are their two highest growth areas, and also the biggest part of their revenue mix, accounting for about 88% of their Q4 revenue. And if you look at 2024 overall, it's at about 86%. And then if we break it down by technology, we can see that in 2024, the 5 nanometer and 3 nanometer chips basically made up 52% of their total revenue mix, which is up a lot from about 39% in 2023. And why that's important is that TSMC is a global foundry leader, but especially as it relates to the most advanced chips. So anything 5 nanometer and below is really where there's not that much competition for what they do. And you can see the trend on this chart. As 5 nanometer and 3 nanometer chips become a bigger part of their revenue mix, it's just an area where they don't have as much competition. Meaning that right now, over half of their revenue is in an area where they are the undisputed leader, and those happen to be the highest growing parts of their business as well. So a company that already had a tangible market advantage now has an even stronger one that continues to grow. Now, if we take a look at what they're guiding for next quarter, they expect revenue to be between $25 and $25.8 billion, and gross profit margin between 57 and 59, and operating profit margin between 46.5 and 48.5. And here's the thing, if they end up hitting in this range of $25 to $25.8 billion, they're going to have another 35% year-over-year increase in revenue, which is just amazing growth. And at least recently, they've had a pretty good history of meeting or exceeding their own guidance. Now, obviously, every single stock has risks, and with TSMC, it's a pretty obvious one, because the geopolitical risk regarding the relationship between the US, Taiwan, and China is going to be an ongoing thing, and it's not clear what, if anything, is going to change under the Trump administration. But my view on this continues to be that Taiwan Semi is such a critical supplier to important US companies that the US government will figure out a way to make sure there's no disruption there, if at all possible. Plus, TSMC continues to make progress on their Arizona plant, and I think that's going to help as well. And in general, they are continuing to expand to try to get their manufacturing supply capabilities closer to matching their demand. But obviously, that comes with some cost to profitability as they plan to ramp up CapEx spend to 38 to 42 billion over the next year, which is a significant jump to the 29 to 30 billion that they spent this year. Still, with demand being what it is and accelerating in all the right areas, I think it's going to end up being a net positive. So in terms of overall thoughts about TSMC, To me, they were such an obvious winner when I started digging into the company. A lot of investors look at their performance and think that they missed the boat with the stock already, but even now they're a company that's a critical supplier to a strong secular trend, have very little to no competition in the most advanced chips being created to support that trend, and yet they're still trading at a 15 price to cash flow. Now, you could argue that TSMC is in a cyclical industry, and if you follow kind of the Peter Lynch principles, then they say that when you have a cyclical, that the valuation starts to look good and they're spending a lot on capex, then that's when to sell. But my slight caveat to that is that while they're technically in a cyclical industry, because it's really accelerated computing and AI that's driving the revenue, they're still in a hyper growth phase. So to me, it's not really comparing apples to apples. In my opinion, the only real question for investors about TSMC is, can you get comfortable with the geopolitical risk? Because if you can, everything else to me looks like an obvious winner, and that's why I've continued to add to my position. Okay, real quick, let's talk about UnitedHealth and their most recent earnings report. Now, as you guys know, I don't actually hold UNH anymore. It's a stock that I sold almost a year ago now. But they just reported earnings last week, and the stock was down over 6%. And the general theme was that they had a rare revenue miss and medical expenses that continue rising. That's something that we've looked into on this channel before. But one of the things that I was watching when I held this stock was their care ratio, which is basically the ratio of benefits that they've paid out versus the claims that they take in. And this number has been steadily rising for a while, and it was one of my big concerns with the company. Now, in the most recent quarter, it was 85.1%, and they have a lot of different reasons why in terms of the one-time impacts that they're dealing with. But overall, this has been a trend for UnitedHealth that is more than just this past quarter. If you look back over the past few quarters, you can see that it went from 82.2% in Q1 of 2023 to now 85% in Q2 of 2024. And while there's been a little bit of fluctuation, in general, the trend is up. And why this is important is that policy premiums is the largest part of their revenue. And what we see is that their expense growth has actually outpaced their revenue growth over the past year or so. Because both in 2023 as well as trailing 12 months, their revenue growth is actually slower than their expense growth. And if we take a look at what's happened since this video, in Q3 they had a care ratio of 85.2%, and in Q4 they had a care ratio of a whopping 87.6%, and they gave guidance for 2025 that they expected to be around 86.5 plus or minus 50 basis points for the year. So again, a trend that we were watching almost a full year ago continues to go in the wrong direction for UnitedHealth. But anytime you hear people talk about this stock, what you hear is it's a big opportunity, it's been such a good performer, it's a long-term compounder, and it's just out of favor right now and is going to bounce back. And all those things may be true, and I've said time and time again, UNH is the best managed healthcare stock that I've seen. They're a critically important company, and they've been such a good performer over a long period of time. But this is one of those situations where I don't want to miss the forest for the trees. And the simple fact for UNH is this: medical costs are rising and eating into their profitability. Their company and industry is extremely unpopular with the public, which increases the chance that regulatory changes or government intervention could happen, continuing to limit their profitability. And it's simply a business that I don't personally understand very well. So for me, it's a pretty easy decision to sell. And the fact that it's been almost a full year since I exited my position and UNH is trading at about my average sale price means that I feel pretty good about the decision I made, because the reality is that I don't see that the future is going to get any easier. But again, for those who are more knowledgeable about their industry and what's going on there, you might have a different point of view and see this as a big opportunity. So overall, I look at these as two different earnings reports for companies that are trending in different directions. But this is where your own personal investing strategy comes into play, because some people prefer buying stocks when they're out of favor and just waiting until the market changes its mind again. But for others, it's not so much about where a stock is trading today, but how strongly they believe in their business outlook going forward. Either way, the key is to have a plan that works for you and execute on it. Now, if you want to know why I think TSMC is the most important AI company in the world, I break it down in this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.